Welcome to the Personal CFO. Today we're going to be talking about large companies, we're going to be talking about big companies, and we're going to be talking about as a long-term investor, where should you be putting your money? Okay, now of course it's important to diversify. This is in no way an investment recommendation on this video. However, let's look back at history and see smaller companies, larger companies, where should we be putting our money? And something that if you've been watching videos in the past, you might be thinking I'm going to is, well, what are the prices of these companies? Because many times the price we pay matters, in particular when we're talking about long-term investing. So let's spend a little bit of time on this chart. Now I know this looks complicated, don't worry, I'm gonna walk through it. But as you can see, all these dots, right, are going from up and to the left to down and to the right largely, okay? Now, if we were gonna talk about, okay, Kyle, how can we explain this very simply? Well, this is a comparison of the S&P 500 and the S&P 600. Now, the S&P 500 you're probably pretty familiar with. The S&P 600 is small companies. So we've got the 500, which is large companies. We've got 600, which is small companies. And what this does, if you look at the x-axis or the one that's going across, this is comparing, well, when it's cheap over on the left to buy smaller companies, how does it do? Versus when smaller companies get expensive over on the right, how do they do? And the line in the middle is overperformance versus underperformance. So if you're above the line, you outperform the other. If you're below the line, you underperform the other. And here's the cliff notes. The up and to the left dots means if smaller companies are cheaper, theoretically, or not theoretically, historically, the next 3 years, you have an excess return most of the time with those dots. It's not every single time, but as you can see, this is where most of the dots gather. An outperformance buying smaller companies over larger companies when they're cheaper. Makes intuitive sense. Also, the other side of that, when it starts sliding down and to the right, as you go over to the right on your horizontal axis and small companies become more expensive relative to large companies, guess what? You go below the line, which means you underperform. So this, when you're looking at anything, you go, does this make intuitive sense? Because if it doesn't, we might need to unpack it more. However, in this case, it absolutely does. If you buy shares of the future earnings of a company for less, theoretically and historically, you should get compensated more. Great news, that's how it's actually turned out. Okay, great. Well, where are we now, Kyle? In the looking back at history compared to today, where do we land? Well, right now, if you see this line that just showed up, that's where we currently live today at about a 20% discount. Now, keep in mind, this is just after the first quarter of 2023. When you're watching this, who knows where it is? But as of now, smaller companies are trading at about a 20% discount to large companies. What does that mean for the future? Who knows? Because the future is unknown, that's why they call it the future. But where are most of those dots? Up and to the left. Which means if you're buying less expensive assets, historically it's giving you a pretty good chance for decent returns, in particular compared to the other companies that are more expensive. And so again, no one knows what happens in the future, but I think history gives us a good gauge of understanding the price that we're paying for investments. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.